Hi, everyone. Today we have our guest from HypurrFi, Andrew, the founder, CEO, CTO, and Andy, head of growth. We have been working with HypurrFi. They've been instrumental in the Wellspring offering of what we've built so far. We have worked closely for a while now, and a lot of the yield that we deliver to our clients comes from HypurrFi markets. So we'll kick it off. We'll dive into the different offerings that they have been working on, some new releases that they have just launched that the market is super excited about. So let's dive into it, and maybe we can start with some introductions from your guys' side. And maybe Andrew, do you want to kick us off? Tell us more about HypurrFi and how you guys got started, and who's behind the team, and what's the vision? But we can break this up into more steps.
Great. Yeah. Hi, everybody. I'm Andrew, cat in charge here. HypurrFi is, lending predominantly for traders. We focus very much in the trader segment right now on Hyperliquid. We were one of the first lending markets to go live when Hyper EVM went live. And we've been curating experiences for the users in and around the ecosystem ever since. We got started as like a shop, a couple of years ago ourselves. We got together to actually set out to build a chain that was all around regenerative finance and, cash flow driven economics. And along that way, we realized that Hyperliquid was technology that we were striving to have for ourselves in some capacity, not the perp dex, but like just this notion of a high throughput chain for finance. And we cared a lot about diverse assets and looking at how you could actually tap into yield sources that are not just from a single chain, but multi-chain as a vision. So Hyperliquid came along, and in 2024, we decided that this was the place we wanted to hang our hat for, the next little while. And it's turned into something pretty powerful and pretty exciting ever since. Andy's been with us since the very beginning, actually, of this journey around cash flow economics and
Nice.
everything that we care about around, how incentives and, treating a community right and users right is all kind of the core of what we do. I'll let him take it away and introduce himself.
Yeah, hey everybody, Andy here, and HypurrFi is exciting because of the users. And so for Wellspring users, right, the yield comes from people borrowing, and that's not us. Like we don't make that. We make the markets and the infrastructure and those products, but the users come and they want to borrow because they have things that they want to go do, and so they're motivated, they're knowledgeable, they're thoughtful, and so they make concentrated. Like directional bets very frequently, and they need capital to do that, and so they come and they borrow and they pay for it, and that works out well for the users. And really, like we've been in crypto a long time, and one of the reasons I got together with Andrew in the first place, just all about around these cash flow economics and revenue being a powerful motivator, was we were really looking for real users. Like we're true believers in there's good reasons why people want to use on-chain financial rails, and they'll pay to use that. And so that has been the mission, and that's really what we've accomplished thus far and into the future, ideally as well, is people who come and really do want to borrow for real. They really do want to use the financial tools, and the downstream effects of that are fantastic. Right? That leads to other integrators like yourselves deploying all sorts of like cool tooling and things that people can do more with their money. But yeah, personal note, like I'm a dad in the Midwest. We're all a little older of a founder generation on the HypurrFi squad, which we like quite a bit. But we all work remote from around the globe and hustle a lot. I just got called out today that said we respond faster than anybody else, and I was like, yeah, well, we are always online. Like everybody on the team is like, we're pretty locked in here.
I don't think I've ever logged into Telegram and clicked on your name and it said been online like more than 3 or 4 hours ago. So it's
Yeah.
you keep that thing on you. You keep checking, and your guys' community has been growing. And there's every time that I look at the community, there is constant. There's the conversations with so much substance. People are asking pretty complex questions. You guys are answering in a very knowledgeable way, which is very exciting to see that those conversations compared to some of the meme coin chats that maybe we've been parts of a couple of years ago, which was just pure degen.
Well,
That's
crypto
awesome.
is a very wide variety of users. And when I say like our users are traders, those aren't our only users, but those are like our high volume, really passionate revenue generating users. But everybody deserves to know what's going on with their money. And you don't know what situation any Anon who comes into Telegram is in. And so they got a question about, how do I see this in my balance? What does this mean in my portfolio? Absolutely, everybody deserves to know that. And, whether or not they're depositing $1 or $1,000,000 and we have the range, that's a fair
Yeah,
question. And if I can be honest, like when we've responded to those, random Anon queries before, we find out later that we actually are talking to somebody with some pretty serious skrill moving around the trading and economics world there. And so that does
hmm
happen. And so it's not that we don't only do that just because in case you catch a whale, but it is certainly a fair thing to do and just like a reasonable thing to do for any users. Treat them with respect.
for sure.
Yeah, I'll
Yeah,
echo
I
that.
think
Like
yeah,
we've cared thought deeply because we actually truly care around the experience that you get when you interact with us, whether it be in
yeah,
person, be online, or Telegram, like anywhere. Just don't fight me on Twitter. But ultimately, like, if you ask a good question, now, like, there's some of it where we just don't allow for, some lines of conversation. But other than that, like, everything is pretty much straight up open. And we found that it's like, it's a really great way to go through it. We have people who will DM us and ask us private questions. And sometimes like, no, like that's like such a good thing. We want to like bring that to the remainder. Like, for those that are listening, the one thing we don't tolerate is like, promo work and like, asking us to shill you and come into an AMA and pay for things. Like we just don't do that here. Like we're not about TVL deals or any of that stuff. So like, that's what we just don't condone in our chat. People come in all the time and they're always like, yo, can you send me a DM? And it's like, really, if you have a thing that you want to ask, like pretty much you can ask to everybody here. And it's a pretty open forum. So we
Yeah,
really
I'm
encourage that level of conversation.
I'm a former educator, and so whenever there's questions in a class, you do a lecture. The point is not actually answering one person's question. It's finding out like, what did I miss and how can I like reteach this in a way to reframe it. So when one student would ask a question, that's an opportunity to teach everybody and go over it again. And so we really do take that approach in the Telegram. We also take that into our product, right? If we get the same question 2 times, okay, time to go back to the UI, time to go back to the docs. What did
hmm
we miss in terms of how we frame this product and make it accessible? That's what we've been doing all day. We just came out of like this massive like UI revision session, like we just hammering on these tiny little details that now we're realizing like, okay, this one matters. We missed it on the first go around. We can clarify this and make it a much better user experience and educational experience. Because like I said, it's your money, man. Like you should know what's going on with it. That's an absolutely fair request. And so we just try to honor that.
That's awesome. And obviously, on our side, we have been focused on the user experience as well. In fact, if we lead with something, it's the user experience and enabling customers deposit fiat directly into HypurrFi markets, which, the design of our platform was to enable people like my mom, even my grandma, to just wire assets to our platform and that ends up in your markets, and those markets are the ones that generate the yield. And we were super excited about you guys extending the offerings, and the most recent announcement of Mueller. I know that I would say Euler, right? But let's talk more about that, because we're excited. It looks great. We're excited to extend that offer to our clients and start funneling assets there. But let's double click and kind of dig deeper and see why did you choose Euler? How is Euler different from Mueller? And so let's start unpacking that.
Well, first, so the meme of Mueller for the listeners, Euler, EULER, is like a well-known DeFi protocol on Ethereum and a bunch of other EVM chains, and everybody mispronounces Euler. It's pronounced Euler as Euler, and or the other way around. Everybody mispronounces Euler, like I just did it, as Euler because that's just like a natural way. But it's a mathematician. It's pronounced Euler. And so when we
Yeah.
started working with them and thinking about, what this was going to be, we've had a cat branding, right? We got a cat paw. We're kind of goofy since the onset in terms of branding. And so we just memed it to life. It's like, okay, this is going to be Mueller. It's a play on their mispronunciation. It's a cat theme. And it was actually like a secret code
Nice.
name that we didn't tell them for a long time because we thought they were a little sensitive about it. And we did, we were just calling it that internally. But then it was like the week before launch and we kind of ran it by them and they just ate it up. They loved it. And we had another media partner, they loved it. And so we went and tweeted the announcement and then they retweeted and said, you just said Mueller or something like that. And so they totally adopted it. And then it just kind of caught on fire. And so now we've gone with it. Like Mueller is the branding of that. So I'll let Andrew talk about the tech and like kind of like how we're different and what that is. But yeah, there's the backstory on the meme.
Yeah. So if you think
So
about
does
what
that
is
have
Mueller?
anything? Oh,
Oh,
uh-huh.
no, sorry. We may have a little bit of delay. Go ahead with your question, then I'll get into it.
Oh, I was just going to make a joke if you guys name it that Mueller had anything to do with Michael stepping down as the CEO, but those. Let's move on.
I mean, I love it with the whole cat angle because it just shows how kind of correlated HypurrFi is with the whole Hyperliquid ecosystem because you have all the hypercos and then all the different kind of just, I guess, like the cat's the mascot of Hyperliquid. So it just shows that we're really just tapped into that ecosystem. You guys know your user base really well.
Yeah, and it's just like, it's important to think about like, the Euler protocol is the underlying technology, right? It's Euler protocol v2, and it's the canonical for the canonical Euler v2 apparatus, right? So there's been no modifications in that respect. It's but Mueller is just basically like, it's originally our just play on it. But if you think about what it is, like it represents our commitment to Euler in terms of it being an experience that some people have come to know and love, right? So you're used to how your Euler finance applications, your positions, that side of the equation works. And if you just want Euler on Hyperliquid, you don't want anything else, like we want to honor that experience because we think that's an important part of DeFi, an important part of markets is that you just get to experience the thing the way that you want. Now, what that means though is that we don't actively develop Mueller. Okay, so Mueller is shipping a version that Euler Finance develops, and our version is, we update it and snapshot it like way less often than Euler does, right? So new features that may be canon on Euler as an experience may not be available to you right away, may take time to roll out, whatever that might be. That's because we build the future of HypurrFi on top of the Euler or the Mueller market. So when we curate and generate new experiences that are happening for HypurrFi users who, for all intents and purposes are actually using the underlying Mueller apparatuses, this is where we focus our time and energy. So HypurrFi is like an opinionated approach on how to build markets using the Euler technology. And it's just how we think about like the UI and framing it, making it available, our concepts, fields, and whatever it may be. And that comes from dealing and interacting with users who are looking for more than just a specific type of experience vis-a-vis Euler. And so, yeah, that's the big distinction. So like, you'll see us and hear us memeing at a time, but we try to draw the line that like HypurrFi is, our representation of things. And we build our, borrow and lend markets, the future of them get built on top of the Euler technology and Euler stack. And that's for a few good reasons, but ultimately allows us to be more composable and create more experiences that are taking full advantage and full, force of the Hyperliquid ecosystem and apparatus. So being able to build technology that's specific for traders, that's taking into account the full swath and wide array of different offerings that exist from a finance perspective on this chain versus you would see typically in others. And so our reason for going down this path originally with the Euler team was that this is technology that A, scales, B, is modular enough that we can create net new experiences, and C, offers out of the box, a net new offering than what we currently had to the user base. We felt like we had a gap in our offerings. We were either completely correlated, completely shared risk from the pool perspective, or we were entirely isolated, all the way down the risk curve and had no composability, but like pure isolation with our isolated markets that we now call our legacy markets. And so we realized that like sure, we can cut out a large swath of risk here, but the experience that we have to offer when it comes into some of our newer pieces of tech as well that we're building, like the card, gets lost along the way. So programmability and being modular and being flexible in today's market are absolute core strengths. And it originally started as looking at like, hey, if Hyperliquid is the place to house all finance, it needs to have the money market apparatus that is flexible uh, to be a part of that. And we wanted to be that underlying layer. We believe in scalable debt markets for everybody. The house of all finance needs to have a strong foundation of debt for it to be, for it to be stable and sturdy. And so we think Euler and HypurrFi is how we build that.
From a sort of an operational standpoint, for you guys, like you're asset deployers, essentially. Your lending is basically what you're doing, and your users are passing funds through you to lend to our markets. Like that's kind of the general flow. And the
That's right.
old version of HypurrFi, which we call legacy markets, they're still up and available, but we're deprecating those in favor of Euler. It really limited what you could lend and what you could borrow, how much you could lend and borrow, and it was like this really tight bucket that didn't let you do much as a user. What Euler does, it really expands that surface level without getting into the full risk basket that pooled markets are in. And so you can take on assets with different risk profiles, some that might be higher risk, a little more tail assets than something like Bitcoin or Hype, something that's like really sort of standard and known. And you can take a little more risk and earn more yield on that, but you have a little more flexibility. Maybe you want to lend two different kinds of stable coins, or you want to swap between them, or the borrowers want to borrow from three different kinds, or, who knows, right? There's all sorts of different sort of patterns that people might want to take. Euler really opens up and expands that. The amount of different asset types, token classifications, the technical classifications of what you can put in these markets really changes with Euler. And so it opens up a lot more design space for lending and borrowing. But then, as Andrew mentioned, also right next to Hyperliquid, this awesome perps and spot trading venue that has composability between the EVM where we live and there. That's a different setup than has been done on any other EVM chain before, especially with the amount of use and liquidity that's on Hyperliquid. It's massive, right? They've got billions in open interest every day. So like all of a sudden, this is a really different, unique experience, and we needed the tools to be able to provide more advanced experiences for the sophisticated users who really wanted it.
Yeah, and I want to make sure that people are listening to. It's not just for the sophisticated users as well, right? Like, it lets us offer the same comfort and experience that you can get from pooled all the way down to the isolated markets for the legacy, sorry, all together. And the cohesion is there. Like the beauty of this is that, one of the biggest, pain points that people had was, I can't compose my isolated risk because if you think about structured product and building and being able to define the category of risk really discreetly, it makes for a fantastic lending experience, right? Your total max exposure ends here. Worst case scenario, something goes wrong, you've got a ticket you can write. Other markets don't have those flexibilities. And so being able to design something where a lot of institutional capital is coming in, there's different lender types, different market requirements. It's not just an open free for all. The only other answer would have been to create, a dozen different type of pools and have a whole bunch of these different risk profiles that sit out there. And quite frankly, for anyone listening, like managing a pooled market is, not just like a walk in the park. Like it's a full-time job for a team of people to go and facilitate and do that. And so when you start looking at how you want to support different market segments and slices of debt, you start running into a big pain point where suddenly, you can't just give everybody an Aave V3 pool and have it expected to be managed comfortably and do all these things. And so slicing it out and having risk profiles that do become composable pieces of debt or become more infrastructure, if you want to think about it, for people who want to put lending and facilitating of debt markets on top. And so we think this is where the natural order effect goes in Hyperliquid, especially with the launch of portfolio margin that's come out, being able to directly lend to traders that are seeking a relatively secured, I would say from a risk perspective, venue to lend at a decent depth, right? So you may not get the best optimized rate, but for the overall risk you're taking comparatively, it's going to be a pretty good rate of return. Now, not all collateral is going to be accepted into the portfolio margin, and that's just the reality people need to come to bear. And permissionless markets and composable markets are still going to have one of the best, advantage points in this market composition structure that Hyperliquid's bringing out. So if you have the ability to then start offering funds or tokenized funds or vehicles that can be brought on chain that live right next to the house of all finance in terms of, trading facilities. And I have to kind of equate it a little bit, not to downplay the value here, but if the New York Stock Exchange was where value was traded, and you were able to operate right outside the doors of the New York Stock Exchange and offer things to people who are going in to do their trades and do their job opportunities, right? There's a lot of value there, admittedly depending on what you want to sell, right? And so the number one thing people want is leverage, at least from a trader perspective. Access to good leverage, understood, risk-adjusted leverage, whatever it might be, right? And so if Hyperliquid becomes this place, and I've talked about it a little bit on Twitter over the last few days, but I have this notion of your money or your signal has a bias associated to it. So, there's this signal capital bias approach around the value of a venue, right? And it's where price discovery happens and where deep markets start to form. And Hyperliquid's signal capital bias is gone up through the roof. At least this is my lossy framework, so it's not really a defined term, but basically it's the best venue that a trader could want, and you can bring your money in and out with relatively no fanfare. You can react in depth to global market events, so you get micro and macro trading. And then if you want to do anything that is outside the bucket of defined risk on Hyperliquid, vis-a-vis your leverage or trading needs, right? You have a whole courtyard right outside the door that is fully programmable and lets you take on any calculated risk that you want. And so one of the craziest things I think gets downplayed or misunderstood from a lot of the people that may be out there listening or that are trading on Hyperliquid is if Hyperliquid continues to become the place of price discovery, everything that's not inside Hyperliquid Core has to update around the price being discovered on Hyperliquid Core. So if you want to move money or correct something or arbitrage something, you have to put more and more capital at the place of price discovery so that you can take advantage of these adjustments you have to make around your positions. So bridging capital in and out tends to start, moving down the stack in terms of where it can happen. So why all this matters is building structured products next to where money has to move aggressively. So if you have a bunch of these bridges that go in and out of Hypercore, which is your venue of price discovery, you've got your, Circle as a bridge, you've got Tether as its own bridge, Visa Layer 0, Unit's a bridge, but Hyper EVM is where capital can just come in and out and do whatever it wants. So structured product formation is going to become huge on Hyper EVM because it has this closest proximity you can get to price discovery without having to ask permission to exist inside the walls, right? So, the Hyperliquid core team has permission to build venues inside the venue. Everybody else is forced to the exterior perimeter to build their venues. So this is where I become incredibly bullish on the future of lending and market structures on Hyperliquid, is that we get to take advantage of basically a black hole of borrow, I would say, or debt, a black hole of a debt vector. So you have a constant strain pulling capital in to go get spent and, essentially won or lost in a zero-sum game. What that means is that you now have a constant borrower or net borrower of the ecosystem, like an anchor. It's imagine going to a superstore, to a supermarket, or to a mall, but there's no anchor establishment. There's no real reason why you're there. It's all just mom and pop shops. Who's actually bringing the crowd? So we don't have that problem.
Which is most
we have a net
malls
borrower
these days.
Right, exactly. Right. And so structured products start forming around here because they want access to the Hyper EVM yield. They want access to RWA yield. They want access to other vectors, maybe bonds, or they want access to the portfolio margin that, debt sync that's happening. Maybe they want HLP yield. Maybe they want to compete as a liquidator. Maybe they want to offer their own OTC options. RFQs start picking up. You get collateral debt swaps that might start emerging. Real finance starts to grow really quickly around this beacon of price discovery. Now, Hyperliquid has to maintain becoming the vector of price discovery and keeping a high signal capital bias, in my opinion, in order to get that overall, place enshrined. But you're starting to see that, the overall tide shift where we're getting deeper markets than Binance, on some trading pairs. And we're starting seeing that, right? And HIP3 market growth is starting to trend consistently up and to the right now. We see a team today just launched prediction markets out of the blue with their own capital. No, as far as we know, it's all been no outside raising and stuff. So, the future is here. Horizontally scaling our trading venue and allowing us to build debt markets right next to it is going to become like $1 trillion offering.
Yeah, and I think what they did beautifully is enabling anybody to make money on it, right? So it's like you want to launch your thing, you want to market it, you make the trading fees. So not a very common way to do it for an exchange that has deep liquidity.
Right. And that's like, to that point is like that increases the value of building next to it. Right. So,
Absolutely.
companies such as yourselves coming in and, figuring out the abstracted routes for like regular users to get access to the value that's being captured and created, near this. And, we haven't had a venue that's this transparent and getting this level of traction and success before. So it starts to become its own yield engine really,
Yeah.
really quickly. If everyone else wants to just, hook onto that battery and how can I add a little bit to the flywheel to keep this thing spinning a little faster? And then, everyone gets to benefit as a result of it. And so we think
Yeah.
that there is a whole world of finance yet to be built and be created on the back of Hyperliquid. And we think most of the lending and debt facilities start to trend towards the Euler stack that we have here as being that,
Mm.
that place. We haven't launched Euler swap yet, but once that is out and operational, we'll have deep stable markets that are being, pumped into the lending and liquidity aspect of things. So users, traders, those seeking yield, whoever it might be, we become the natural, deep vector of that.
And that's awesome. We're certainly super excited about that. Um, so we will know that the rule number one of finance is the higher the risk, the higher the return. So if we were to kind of lay out the landscape or the structure of HypurrFi, we know it would be, I think it would be great to dig into the curator, the vault, and that whole infrastructure, and like how is that structured? How is risk quantified? How do you guys make the decisions on which markets to support? How is it uh, rebalanced if you do any of that? But I think that like the big picture, so the listeners, all the 5 of our listeners are 4 of them are on this call, uh I understand of, okay, so there's a smart contract, then there's the curator, then you guys did some sort of due diligence to make that an available market. So can you guys walk us through that logic and kind of the structure of how these markets are created, and also maybe the difference between uh, pooled, isolated, and
Yeah. So I think it's really important to start from a framework of over collateralized lending. So most
Mhm.
lending that people are familiar with, traditional sense, is not over collateralized. It's under collateralized. I go to buy a house, I put down 20 grand, right? 2%, 10%, however much of the money I owe, and the bank is going to hold my the deed to my house in like reserve. If I default, then they can go and repossess the house because I have not put up more collateral that I want to borrow. DeFi lending and everything on HypurrFi is over collateralized. If I put in $1,000 worth of Bitcoin, that's my collateral. I can't go borrow $1,500 worth of Bitcoin. That's not how it works, right? The contracts are set that they do not allow that. And the reason for that is so that users have safety and security with the collateral that they put up, the funds that are lent out. So there is some buffer there that is known so that there's not people in the loop deciding who gets liquidated and who doesn't, and who gets their collateral back and who doesn't. So that's like the first level is like the revolution of over collateralized lending and smart contract and decentralized sort of on-chain finance lending is the root of this. Is if we can be trustless about it, we actually do need over collateralized. Now that changes some assumptions about how funds flow. So then when we go into a risk market, when we think about like, does an asset belong in the pooled market? It's not just about whether or not that asset belongs because it has a nice name or it has a lot of liquidity. We know whatever's put in there has some amount of value that's going to stay with it right there, and the amount that's put in is going to stay in there until the user withdraws. Somebody's not going to put in a Bitcoin and then somebody's going to borrow that full Bitcoin out. It's not permitted by the system, and that leaves this additional room for lending and borrowing rates that kind of set up this curve, sort of this interesting yield curve, which is where the money comes from. Now I'll let Andrew talk about kind of the process of getting there, but understanding that there's more money in the system waiting than is going out is a really critical feature that is quite different from traditional.
And I also think it would be good to touch on, which is a question that we get all the time. Well, if it's over collateralized by Bitcoin, what if Bitcoin drops? How is that? How do you handle? So there's obviously there's the workers, or what do you guys call them? The gnomes, or uh,
There's some magic in the middle, but we know how it works.
okay,
Yeah,
sweet.
great question. So how loans in DeFi are structured? Well, I mean, most loans actually, but if you think about how we structured the loans in DeFi, is you post collateral and you get an LTV, a loan to value ratio. And depending on the market and how the technology for it is designed, it may also have what's called a liquidation loan to value ratio. And so the difference here is one is how much you can borrow, which is your LTV, and your liquidation LTV is at what point in time you get liquidated, margin called, and it's sold into the open market or made available for those to basically come buy and sell. And if you think about it, if you had $100, okay, and you were allowed to borrow 60, okay, I will then, at some point in time, if needed, the outstanding loan is worth 80% of the collateral you posted, then I liquidate you. And so if you posted $1 and you borrowed 60 cents, or you posted, Hype worth $1 and you borrowed 60 cents, but then your outstanding loan, like the Hype depreciated in value. So that's original 60-cent loan you took that was worth, 60% of your overall collateral. Since the price of the collateral has gone down, it's starting to hit that point in time where maybe you're going to get liquidated. So the second your loan is worth 80% of your collateral, we say, sell it. And it gets made available automatically through smart contracts for people to come and buy it from the system in exchange for the debt that you've taken. So depending on which debt you've been exposed to, if it's stable coins or other assets, whatever it might be, they need to bring back that asset that you're being liquidated, and then you, the borrower, are charged a penalty. And so it's always beneficial from a borrower's perspective to repay your debt versus getting liquidated. Like always, because
Right.
there's a tax on being liquidated, right? And it comes from your collateral posting. Now, risk and safety measures come from ensuring that A, the assets you're onboarding have high liquidity, and B, that the ratios that you're allowing for debt to be basically put against that collateral is sufficient with those penalties, so that should a liquidation have to happen, there's enough incentive for some participant to come and clear the debt. And now there are cases where the market tech, as an example, let's look at Isolated as an example, where Isolated doesn't have any spillover, right? If you had a situation where you had a meme coin market, or you had some kind of volatile pair, and somebody created a market and that was badly parameterized and bad debt occurred, right? It's only to the lenders that are inside that actually put capital into that basin. There's no ability for them to go and aggrieve somebody else. Now, the pooled is a different scenario, where pooled risk shares equally the responsibility, or basically the vector of exposure of all debts. And so if there's a bad debt scenario, socialized losses across the pool, everyone harbors that risk. Earn vaults are in the same category. You deposit to an earn vault, it's going out and it's depositing to a bunch of other markets, and those markets, depending on how they are classified, carry different weights and risks. We classify our prime markets as being one of our lowest risk venues. It's all just basically blue chips, where we don't add any undue tail risk or nothing. It's just straight up stables and some low risk high liquid assets. And to get into the prime sector, over time will become more of the more liquid venue by default. It'll pay less rates though, because it has that higher degree of safety in terms of it's not offering LTVs that are pushing the overall risk curves that would warrant for higher degrees of leverage coming into the market. Our yield vaults, or sorry, our yield markets are where we have relatively relaxed conditions in terms of how we want to manage the risk. It isn't to say that they're riskier markets; they're just further up the risk curve. And so, if you're trying to target something where, you want assets that are going to be way more active in terms of using the capital, so most likely have borrows going out. It's going to be out for a quarter, maybe longer, depending on the actual user base that comes through. Um, so they will be a great source of yield for those that are looking to build around it. So structured products, we're going to be, loving the actual notion of the yield market, how it composes, and the different compositions and the LTVs that it enables are completely different. That's a whole different parameterization set and justification for the yield markets. And then, the cool part about this whole design and equation is if ever a risk opportunity, borrowers and lenders who both want to be matched into the risk, it's not our job to tell you what risk you want to take on. If they emerge, we can create a new cluster or a new market or an island. We call them risk islands, where we can bespoke the needs of the market much more differently for what the actual market segment wants, versus trying to make something that's more applicable to a wider variety. Um, there's a lot of nuance around how you can lend, right? So if you think about the earn or the vaults that we have, the earn vaults, it's being delegated the responsibility for finding the good yield off to our curator, who is ClearStar, and they're fantastic. For anybody that's out there listening, ClearStar Labs, give them a shout out, follow on Twitter. We're incredibly fortunate and love working alongside of them. Their approach to diligence on teams, everything the whole way down from how they analyze dependencies of the markets. They want to understand all moving components and really allow us to underwrite risk much more holistically from an actual design perspective. But
Yeah. So
anybody's able to participate in any capacity or across any of the vectors that they want. You don't have to, dial in. You can go as deep as you want to, or delegate, as well. Sorry.
let me give you a made up example.
Let's
So
hear
somebody wants access to a brand new stablecoin called Pepe USD. And Pepe USD, there might be one. I don't know. I'm just making this up. Pepe USD is attractive to people because it pays some crazy yield rate just by holding it. And so there's some traders out there who are like, all right, I want some Pepe USD, but it's denominated at $1, it's relatively stable. And so I want to lend that, post it as collateral, and I want to go borrow stablecoins. I want to go borrow USDC and go buy more Pepe USD. So those are the people who have Pepe USD, they want the market. They want to borrow against their Pepe USD, and they want to loop it up. They want to leverage up into this because they're going to try and get some great yield rate. So do we create the market? That's the question. Okay, so what risk do we take into account? Well, ClearStar, we work with ClearStar, a risk provider that Andrew mentioned, and when we go with them and we take a look, what is Pepe USD? What is it backed by? How does it work? Because if people lever up on this and they start lending against it, and then turns out the whole thing was just a scam, when that position is liquidated, it liquidates into nothing. And so then the lenders would be out, right? There's no money to return to them in the smart contracts. So a lot of the risk and due diligence that we do is this a real project? Does it have backing? So if you are borrowing against USDC, USDC can be redeemed through Circle, through their portals, the market makers. You can get dollars for that. It is very straightforward. Tether, it is a well-established USDH. That's what they've been working on, these native markets partners. That you can redeem for that directly. And so when you go and think about what asset would be good collateral, that's what you think about. If it can't be redeemed directly for dollars, you have to go look at the market and say, okay, well, what's the liquidity? Is there deep liquidity for this? You go look at Bitcoin. Is Bitcoin good collateral? It's great collateral. You can sell Bitcoin all over the place. It's got incredibly deep markets. You're not going to sell, half of a Bitcoin and just totally change the price in the given market you are, because there tends to be enough liquidity on Bitcoin for that. But Pepe USD, you can only get it at this one, shop out back behind the bodega. No. All right. You gotta, that's something that wouldn't pass. We also do analysis on what are the pricing oracles. How do you get price data? Are they robust oracles? Are they good? Also liquidity in the market. Some like Solana. Solana is a great, Sol is a great asset, but at first, when Sol launched on HyperEVM, there was not a lot of liquidity on HyperEVM, and we needed on HyperEVM to process these liquidations automatically. And so we kept it out of the market until its liquidity grew so that we could then meet appropriate risk standards in case things needed to be liquidated. So those are kind of like the core like risk elements that we go and look at. Is this the project real? Are redemptions? There's some LSTs that we have like stake type and K hype and B hype and these other sort of hype variants where you stake them, they go and do something with it else, and you have the liquid token, the K hype that you can go and use as collateral. Because I can always go redeem that for hype, but the question is, how long does it take to redeem it? Some of them have like long lockups and there's a redemption period. And so that goes into the risk analysis. Okay, if it's going to take people 2 weeks to get their underlying asset, that's not an atomic instant liquidation. So we've got to take other matters into account. So when we talk about like risk and due diligence analysis that we're doing, that's the sort of stuff that we do is we set up a market so that it'll work, so that it will be a good debt, and so that it will repay itself and liquidate and do liquidations and like make sure those parameters are tuned just right. That's our responsibility, is just to create these the markets, make sure the infrastructure works and runs. Now, if the price tanks, but there's plenty of liquidation, like we're not responsible for the price. That's a risk you took. That's the user sort of situation. But with over-collateralized lending, the way it should work is you can lend to somebody who's willing to take that high risk, right? They have collateral, silver. Oh my God, look at silver today, right? You use silver as collateral. You took out a bunch of loans on silver. I'm sure people are getting liquidated today because the price can change. The system needs to work. We're the system. We make sure the system works and operates. That's what we rely on Euler for, and Aave for our pooled markets, and all this other tech. ClearStar for the risk and like building those sorts of things. But packaging all that together, that's HypurrFi. It's like sticking it all together and like letting the users decide.
So when we're talking about a price just dipping significantly, what measures are in place, or how do you make sure that because obviously the markets are tanking across every lending platform. So how do you make sure that the liquidation mechanism actually performs at the right time and it doesn't go past the triggers? Is there some sort of competition where there's different workers competing for it, or how do you make sure that that side is protected?
Yeah, that's exactly it. It's completely open market liquidation. So they're not restricted to just us, and you're not relying on just our technology running and servicing it. In fact, we like to consider ourselves like the backstop liquidator. Like we have people who are running liquidators for their jobs, basically, like that compete at scale. We're always looking for more people who want to participate in it, as well as we are integrating some RFQ options for cases where we need to, be more assertive. One of the biggest things, though, is the notion of open market and the penalties, right? Like anybody can come read the docs, run a liquidator, be there to show up when the oracles tick over. To prevent against cascading liquidations, in terms of, the whole market going down. Like there's not a lot that you can do in the broader spectrum of things, as long as it's not related to Oracle failures. And we use robust Oracle providers across the board. So shout out to them. And so the notion here is that the biggest failure comes down to liquidity. And the argument you should have against that is that your markets would be priced accordingly with the actual liquidity in the ecosystem. Now, you can have markets that are mispriced from a risk perspective. They're allowing too much leverage out versus what you can actually clear. There's an old adage that you can't underwrite more leverage than the market will clear. And that holds really true when it comes to per exchange. We saw some incidents, with some, we had to tighten some risks around some of the assets that could trade on the Hyperliquid perps. Just as an example, I would say we, like the community, not us at HypurrFi. And, we had to figure out, more, like, I would say, conservative conditions by which that the markets, once they got to a certain size, to operate in. And then, that holds true for lending, just like it does for anything else that relies on external price feeds or liquidity for whatever to clear its books. Now, I will say, though, that like even in the worst of the worst, though, 1010 was the worst day we've ever seen for, market capitulation across the vein, right? Not that we won't see worse. Like we could still go down 80% from where we are right now. But, one thing holds true is that absent like, heaven forbid, Binance being hacked and all the capital being like stolen, like I don't know what that, 80% one candle nuke to zero, comes from. And, but I'll be honest though, like should that be what kills the overall lending markets? Like, I don't know what was going to save any of them anyways. Like, it's not just one lending market. It's all of DeFi. It's most of TradFi. Like, we're talking about, the end of money is most likely when things get bad. So, Oracle manipulation and flash crashing and stuff like that, knock on some wood here, is largely a solved problem by adopting robust networks that filter all that stuff out and have sanity checks on data, clean it. And this is no different than what happens at a TradFi shop. If you're thinking around how lending desks work at any bank, they have price feeds that they utilize. They get indexes. They figure out some mark that they're going to actually price your debt versus your collateral against, and they will margin call you applicably. For DeFi, it just happens in
Yeah.
it's more of a dance. It's a number of, multiple actors coming together for, greed, basically.
But you can see that. So
Makes
this
sense.
is like core to what we build is transparency. So when you go to a market that you're lending to, you can go and see what Oracle do we use, and it's on there. It's on the page, and you can click it, and you can go to the contract, and you can see it, and you run it and see that it updates every second or minute or 5 minutes or whatever its heartbeat happens to be to get an accurate price update. And you can go and see who manages this Oracle. Is it a Redstone Oracle, Pith, Chainlink? Like what Oracle is this? You can go do all your due diligence as an individual, just one person on a computer. You can click through and go find that. Same for the pair. Like if it's Bitcoin and USDC liquidity, you can go to a DEX and just see what's the liquidity on there. Oh, there's $10 million worth of liquidity on there. This lending market is 1 million. Could that absorb $1 million worth? Probably not all at once. That would affect price pretty significantly, but like you can do that yourself, and you can go do that detective work. And that's what's pretty special about this is like the due diligence isn't just on us. It's like, no, here are the risks. Here is the information. You decide for yourself. What do you want to take a risk on? What are you comfortable with? Given the price, right? And then, okay, to lend to this riskier market, the APYs go up and you get good rates. Are you willing to take on that risk for this price? You judge for yourself, because every single person is going to have a different level of risk that they're comfortable with. I mean, me personally, I'm in crypto. I'm comfortable with risk, but I have baskets, right? I have my don't touch. This is boring basket that doesn't touch any risk or very little risk, and then I have my stuff all the way up too. So that's for every individual person.
And in the case of 1010, did you guys have any hiccups or any bad debt accumulated? And if you did, what is the process of sorting that out? Just what would be the example of like a red swan or black swan event
Yeah.
like that? And how is that handled?
I'll be honest, like, it doesn't even humble me to say this. Like, I'm surprised we didn't have liquidation issues across the board on the EVM. Not just with us, but I mean in general. Like 1010 was an insane event.
Yeah.
Okay. Like, it's just shook me to my core watching it unfold. And the worst part of it, like, not even from the operator perspective, but individually with my money, you're like, I'm not even comfortable making a directional bet or choice here, right? It was just so uncertain. But our biggest question we had for ourselves was, like, all of our systems registered that everything was A-okay. We had liquidations that had went through, but we where we were also reporting like 87 positions, I think the number was roughly, that couldn't be liquidated. The liquidator was just spitting them out that it couldn't be liquidated. We're like, oh shit, this could be a problem. So looked into it and we're like, oh, something's going on. Like we can't seem to clear these ones. Is there no money in the market to clear these things into? Like, why is this triggering? So we like did our investigation work and had to dig in. It was like, an all hands on deck kind of thing. So it was like, I
Yeah,
think
I can
maybe
imagine.
5 cents worth of dust that the liquidator couldn't purge because the swap fees were like 20 cents by default through the whoever the aggregator we were using at the time. I think it was GlueX, and so a minimum 20 cent, but only 5 cents worth of collateral, so it couldn't actually get a positive liquidation. So we just cleared that ourselves manually. We're like, okay, like let's go in and fix these ones out. But like it was a testament. Like, okay, we need, like, we found out where our failure case was. When we get these little tiny pieces of dust that need to be liquidated, we didn't have any mechanism to just force it through. But otherwise, like, I think most of the major liquidations, we only had Well, there was a huge hype drawdown beforehand. I can't remember the series of events before 1010, and we started to rally back, but
Mm-hmm.
our users hadn't re-leveraged from the massive like deleveraging event that had happened. And so our users were in a relatively conservative stance. I think we only saw a net and total liquidations of maybe like 600,000 across the board, which is nothing compared to some of the broader market. But we had previously that like had 3 or 4 days in a row of just liquidations only, like a week or two prior to 1010. And so we had major deleverage happening across the board. It was like a K-hype DPEG down to 97 cents or something like that was one of the big like marquee delever moments that we saw across the EVM. So it's been interesting to watch it unfold. And one thing we work on is getting more people to come into the liquidator game and try to open them up and try to find more cases of in the moment capital, because liquidations are
Mm-hmm.
really weird beast, right? Like if the overall market never hits the price point, like you could have a $50 million liquidation that's going to trigger in $5, and if it does, shit, you need to find $50 million to buy the collateral to pay off the debt. But if the price never drops $5, you like never need to do anything. It's like, so it's like Schrodinger's liquidation basically. And so you need to have a
Yeah.
good system where you've got liquidity that wants to come and play. Now, one of the cool parts of the Hyper EVM is liquidations are partial. They're not full on. Like, well, I mean, if the market's crashing, you can buy way more, but they're designed to be bites. So you just take little snippets of the position at a time rather than like consuming the full position. And Hypercore has all this deep liquidity. So as liquidations happen and like your price does get to the point in time that a user could be liquidated, you've got, for most markets, 8 to 12, sometimes 15% buffer on that penalty that a borrower has to pay while being liquidated. That price can still move and juggle around before your collateral is into the bad debt territory. And so you can get a really fast like liquidation cadence with Hypercore, and sizable liquidations can come through too. And so that's a part of where we're actually taking our engineering efforts this year is we've got a prototype of how we can do liquidations asynchronously. So most DeFi protocols need atomic liquidations. The clock rate of Hypercore next to the block speed, sorry, of Hypercore next to Hyper EVM, and the aggregation loop that you can get there is so tight that you can actually do some, cool, like I guess capital routes that allow you to liquidate through Euler vaults directly into Hypercore and back. And so you can reduce that penalty cost on borrowers, but overall, bring in some of that revenue that comes from a liquidation into the overall lender base. And so it really closes the loop and provides a more, holistic experience for borrowers when it comes to where their capital goes out. Because, like it, you hate to say it, but like if a liquidation pays way more to the party that's coming to liquidate the borrower to bring safety than it does on what some lenders will earn over the course of the year to the borrower going out. So a great example is like you may pay 5 to 7% on your stablecoin borrow, depending on the market, right? But if you get liquidated, it's a 13% penalty. And that goes to somebody just bringing capital in the moment for safety. So how do you close that loop by
Yeah.
allowing lenders who have capital to be there in the moment to take care of that debt and service the market? So a lot of interesting things we can do to make for a better overall experience for borrowers and lenders.
That's really the crux of this year for us is how do we leverage this tech to bring net new experiences, more valuable experiences, streamlined experiences? How do we speak directly to our users with the Euler markets? The Euler UI is well known for being a little complicated. It's a very sophisticated DeFi native user experience. So how do we make that more apparent for people who just want to get access to quick leverage or quick access to funds or quick access to yield on lending? Those are
Mhm.
our missions. And how do we just make those systems more efficient? So the other thing I did want to say when it comes to this year is, and this is particularly germane for you guys, is so we have these isolated markets that we launched last year that we've stopped launching new ones. And those are great sources of yield. But we have expanded from those. We're deprecating those and moving everything to the Euler markets because it allows for so much more composability and flexibility. That means we have
That's awesome.
stopped creating those new markets a couple of months ago. And so we've kind of had this lull in new assets and new markets where people can get excited and get yield. That is changing. So these new Euler markets, now that Euler is live, the UI is updated. Andrew might be pushing a new version out right now of the UI.
Oh, let's go.
It looks really slick. Like it's just tweaking edges, but like it looks really slick. But we'll have new markets coming. And so next week, as of this time of recording, we'll have our first one. And then we should have a very regular cadence. We have this huge backlog of teams and assets that want lending. They have
Yes.
assets and their users want utility and they're willing to pay for it. So should be a lot of opportunities. Incredibly excited to tour you guys around the new landscape that we bring.
Yeah, that's awesome. I guess like looking even more forward, what else is coming down the pipeline from HypurrFi in the next 2 months, 4 months, 6 months, even a year out? Because obviously with this Euler upgrade, it kind of opens up a lot of more doors and opportunities for you guys to expand on.
Yeah. Well, we've got our card. So we have a card beta, a credit card out right now. And what's interesting about this card is when you spend with it, when you buy coffee, it in real time takes a borrowing position from your HypurrFi position. So that's a net new experience in DeFi. Is it works with the on-chain collateral to do that. So you're not selling crypto to make a purchase. You're borrowing and you repay and refinance and do everything with your rates on chain through HypurrFi. So we'll have the
It's almost like a
actual
line
full
of
version of
credit
that.
you give yourself.
Yeah, it's your own line of credit. You said it. Like it's awesome, and it's magical experience. It's really really good. But we'll have the full version of the card coming out with benefits on it, and yeah, all sorts of better stuff, including the ability to tie it into Euler markets, including a tie into Euler markets, which means there is a potential when there's enough liquidity and risk is okay for some of these long tail assets that people want to use as collateral. They can borrow against them with the card. So potentially LSTs, right? You can lever up on one of your new Pepe USD. If we decide to list it, it's not a scam. It's great. Then maybe you can borrow against that and go pay in the real world. And so there's all sorts of really interesting opportunities that we're talking to many teams about with that. So card is coming as well. We also have our own trading terminal. So with Hyperliquid, you can use Hyperliquid builder codes to access Hyperliquid's order book and liquidity and markets and just put them in your own UI and give them as an experience to your own users. And we've been approached by many of our users who are already borrowing from us or from our users, and then they go to Hyperliquid to trade. But now they could just do it on our platform in one go and cycle through the earn vaults and Euler markets as well. So a number of other sort of initiatives like that, ideally some markets that have some great institutional use cases as well for those funds or actors that need a little bit more compliance or KYC or insurance in their markets. We're exploring all of those things and more.
I think our listeners will enjoy this deeply because not only it explains a lot about HypurrFi and Wellspring and where the deal comes from, but it also gives a very strong fundamental explanation and breakdown of how DeFi lending works and what over-collateralized lending really is. So we appreciate you guys hopping on and telling us more about what's under the hood and how the sausage is made. Any final notes you want to leave us with, and we'll wrap this up.
Love talking to you guys and explaining these concepts. It's kind of my bread and butter. We are doing even more than what we've talked about here. We are very AI enabled and marching very strongly and quickly down that path as well. So we're just trying to build good financial products that people want access to and find real users. And so I love talking about this stuff and having you guys here, but follow our socials at HypurrFi. I'm Andy Hi-Fi. He's Andrew Lloyd. His handle is there on Twitter. So you can find us, join our Telegram, ask the questions. You guys got a dumb question? Please give me the opportunity to explain it. I'm happy to do that. And good to see you guys. Good to hang out a little bit.
Likewise. Awesome, gentlemen. Thank you for hopping on, and we'll see you in Telegram.
Yeah, thank you guys. We'll see you soon.